Hello and welcome to the presentation 5 questions to ask when buying term life insurance. Let's go ahead and dive in to what we will be covering today. First bullet point. Should you buy life insurance? Is a very important question because without really knowing the answer to this question, nothing else really matters. How do you know if you need life insurance? So we will go through 3 things that will help you determine if you need life insurance based on your individual circumstances and what you are looking to accomplish for your family. Secondly, how much coverage do you need? I'm going to teach you about the 2 ways of determining how much coverage you need. There is a rule of thumb approach, and there is a precise calculation. You use one or the other. I'm going to give you those so that you can kind of know what they are and which of those will be what you want to apply to your situation. Secondly, which type of term should you choose? There's more than one type of term policy. I'm going to educate you on the different types of term policies and explain which of those types you'll be using depending on the situation you might find yourself in, or more specifically, what objective you are attempting to accomplish. Fourthly, what factors determine your approval and rate? I will also be describing the differences, primarily the pros and the cons to medical versus non-medical policies. Roughly between 60 and 70% of new life insurance applications are for no medical exam life insurance policies. So it is worth noting that the majority of people do go for the no medical exam policies, but there are a few cons that you want to know about before deciding on medical versus non-medical, and then which company you should choose, and then we'll wrap up with a few tips that I think are important for you to know that will help you maybe structure your policy properly. I'm going to teach you a little bit about laddering. We're going to talk about temporary insurance agreements, alternatives that for term life insurance that you might want to consider, and then we'll briefly touch on estate planning. Obviously, if you are buying term life insurance, you're doing that because you're thinking about the future, right? You're thinking about your family. Well, you're going to buy term life insurance. You also need to think about your estate plan, right? You don't buy a vehicle and never and not change the oil, right? So the thing we want to think about is how does your term insurance coverage fit into your overall financial plan? More specifically, how does that term policy work within your estate plan? Okay. First question, do you need life insurance? Now, to answer that question, I formulated an acronym, ILL, which is at the top right corner of the screen, which stands for income replacement, liability coverage, and legacy creation and preservation. The thing here is with income replacement, what you are wanting to ask yourself is if you passed away today or tomorrow at any point in the future, would someone's lifestyle be drastically or negatively impacted as a result of your income no longer being available, right? This is for you married couples. This is for you single parents. This is for you who have special needs children or individuals that you're taking care of. This is all about ensuring that there's enough money left behind to pay whatever ongoing bills have to be paid. The light bill, the gas bill, the cell phone bill. These are things that we don't think about on a day-to-day basis, but when you lose half of your income because your spouse passed away, you do start to think about those things. So, income replacement is all about ensuring there is enough money left behind to help whoever that surviving dependent beneficiary maintain their lifestyle. Second bullet point is L, which stands for liability coverage. It is important to note that when you die, your debts do not necessarily die with you. Do you have a lot of credit card debt? Do you have mortgage debt? Do you have auto loan debt? All of the liabilities, either installment loans, revolving credit lines that you are paying on monthly or annually, these will not necessarily die when you die. They become attached to your estate. So the second reason that you would want to have life insurance coverage, or stated another way, the second way to know if you need life insurance coverage is to ask yourself, are there any liabilities that would be remaining that would become a burden to my children, my spouse, my mother, my son, my whoever that may be? The purpose of life insurance, one of the purposes of life insurance, is to pay off those liabilities so that they are not burdens to your estate. Okay. And then third bullet point is legacy creation and or preservation. This has to do with all of the money that's left over after you've paid off the debts, after there's been enough money put into an account to help pay those ongoing obligations, ongoing monthly bills, after the money has been set aside for income replacement and liability coverage, everything that's left over is for legacy creation or preservation. This is about elevating. It goes beyond paying stuff off. It goes beyond income replacement. This is about elevating the financial position of your beneficiary, of whomever that individual is, so that they not only have enough money to survive, which is what we're doing with the income replacement piece and paying off the liabilities. We want to make sure they have enough money to thrive. Now, legacy creation and preservation may or may not be high on your priority list, but in a lot of cases, it is, especially if you are someone who has struggled. You have worked very hard your entire life to maybe ensure that at bare minimum, your kids have the house. Maybe you can't leave them a lot of money, but guess what? You can leave them. You can leave them a house that's paid off, or you can leave them a bucket of money where they can at least go to school to get themselves, maybe they can get themselves through high school, get themselves through college, or start a business, or pay whatever taxes that have to be paid, any of the fees that have to be paid, right? Estate planning, okay, is designed to help preserve your estate. But beyond that, not everyone does estate planning. So if you pass away and there's monies left, you have not created an estate plan, guess what? There are fees and court costs and taxes that have to be paid. So life insurance is designed to do those things, to leave an inheritance, to pay those fees and taxes, and to hopefully provide monies for your surviving beneficiaries to have an elevated standard of living. So again, ILL is how you determine if you need life insurance. Okay. Now, how much coverage do you actually need? Now, there are two approaches to calculating the amount of coverage that you need. The first approach is called the income replacement approach. Now, depending on who you ask, most financial planners will tell you between 10 and 20 times your income is what you need in terms of life insurance coverage. So what that means is if you make $100,000 per year, you need about $1 million to $1.2 million on the low end, and as high as $2 million on the high end, in order to ensure that there is enough money left behind for the what? ILL, income replacement, liability coverage, and legacy creation and or preservation. So the goal here is to sort of make it as simple, as straightforward as possible. If you're a married couple, just take whatever your joint income is, multiply it times either 12 or 18. And if you have minor children, minor dependents in your household, you're going to add another $100,000 per minor child that you have in your household. So in this example, 100K, if that's what you make per year, you have $1.2 million. But if you have two minor children, you're going to add 200,000 to that, which would bring your total life insurance coverage to $1.4 million. So again, that's very straightforward. If you're not looking to get in the weeds and pull statements, do research on your assets, your liabilities, all of that. You just want to keep it simple. The rule of thumb is 12 to 18 times your annual household income. That should get you about what you need in terms of required life insurance coverage. Now, the second approach is what's called the needs-based approach. We call that DIME, the DIME formula. The DIME formula stands for debt, income, mortgage, and education. This is a way of us calculating. We go in and we're pulling our liability statements, all the debts that you owe, the income that you make, and that you're expected to earn over, say, the next 20 years or to your life expectancy. Your larger debts, liabilities here are primarily everything except your mortgage, and then you're adding your mortgage debt to that because that's typically your largest debt. And although some people will tend to buy mortgage protection insurance separately, but we'll get into that in the next slide. And then education is a catch-all for legacy. It could be higher education expenses, could be estate taxes that might need to be paid, just could be inheritance money that you might want to have remaining maybe in a trust for the benefit of your minor children, or maybe you have a church or a fraternity if you don't have any children. The goal here is to be precise, whereas the goal here is to be approximate. If you go use the income-based approach, an income replacement formula approach, that will usually be good enough to get you about what you need. So again, income replacement or needs-based approach, either or, you don't do both. I will tell you the income replacement formula will tend to get most of you more coverage than the needs-based formula. So if you want to be safe, in most cases, go ahead and use the 12 to 18 times multiplier against your household income, and that will get you about how much coverage you need. Now, this is about the different types of term insurance from which to choose. There's more than one type of term insurance policy. You have a level term, annual renewable term, decreasing term life, and a return of premium term life. Now I'm going to briefly describe each of these, and in the bracket here you can kind of see right below next to these terms I have examples of why you would use the particular type of policy that is in bold. The level term life insurance policy is the most common type of policy. This is what most of you are looking for. This is life insurance which provides temporary protection for income, liabilities, and legacy. That's that ILL that I was talking about the last couple of slides. It's about making sure once you've done that either income-based calculation, income replacement calculation, or you've done the DIME formula approach and plug those numbers into the calculator and you figured out what that number is, your level term life insurance, if you want to cover all of those things at once, income replacement, liability coverage, and legacy creation and or preservation, you want to cover all those at once, you want to use a level term policy. Okay, again, this is the most common type, the 10-year, the 15-year, the 20-year, 25-year, or the 30-year. All of those are going to be your standard term lengths. They're going to be level term, meaning the face amount or the coverage amount is fixed for said term, and the premium is also fixed for said term. So again, fixed premium, fixed coverage. Annual renewable term is a term insurance policy that gives you a automatic renewal at the end of each term. Okay, so it is for example, could be a level term policy that you bought, say 20 years ago. If it has an ART attached to it, what that means is that at the end of that 20-year term, you're going to receive a notice from the life insurance company, and they're going to say to you, you can continue your coverage as long as you're willing to pay the increased premium. So the premium in this example is only fixed for the initial term. After that initial term, meaning at the end of that initial term, you're going to pay the increased premium each year unless you buy another level term policy. Now, this is great because you do not have to prove insurability. So you don't have to go back and answer health questions again or take another medical exam. All you need to do is just pay whatever the premium is. So with this one, the first one, you have what? Fixed coverage and fixed premium. With this one, you have fixed coverage, but the premium is only fixed for a certain period of time, which is that initial term. After that, you pay whatever the new premium amount is, which could be significantly more, but the benefit is you don't have to worry about not being able to obtain insurance, especially if your health is borderline. Okay. So this is great for those of you concerned about not being insurable at the end of the term. Just go ahead and get an ART policy. You don't have to worry about it. A decreasing term life policy is a term insurance policy that has a fixed premium, but the coverage decreases. Now, this is what's usually used for your liability coverage. For example, mortgage protection. If you're looking to have a separate policy to cover your mortgage, right? You want to keep a separate policy to cover your mortgage. Mortgage protection coverage is usually in the form of a decreasing term life. And think about that because when you first take out your mortgage, you're going to owe a certain amount. But because it's usually a fully amortizing loan, each year that you or each month that you pay your premium on that mortgage, your principal decreases, which means that your required coverage decreases. So a decreasing term life insurance policy is a policy whose coverage decreases, but the premium stays the same. Again, mortgage protection, SBA loans, just to name a few. There could be instances where you take out an auto loan, maybe you finance an auto loan with your credit union. There could be a host of other situations where you're taking out loans and the lender might require that you take out a term insurance policy and that they be assigned as a beneficiary on that policy in the event of your untimely death. So in other words, they can get their money, right? You could die during the term. They would like to receive their money. So that is what the decrease in term life does. It pays off that loan if you die during the term, okay, or the loan balance. And then we have finally what's called a ROP, R-O-P, return of premium life insurance policy is a term policy that provides a refund to you at the end of the term if you outlive the term, which most people do. So you are 30 years old right now. You buy a return of premium term policy and you say let's say it's a 30-year term, you're going to be 60 years old when that term expires, right? Well, if you were paying $1,000 a year for that coverage, that's $30,000 that you would have invested into that term policy over that 30-year period. The return of premium allows you or gives you a refund at the end of that term. Now, here is the thing with return of premium. A return of premium policy will be more expensive than a level term policy because you're paying for that benefit of having the refund. I'm just going to give you for an example. Let's say your level term insurance premium is $50 a month. $50 a month, 30-year term. Okay. So you're paying $600 a year, okay, for that policy. You would have paid $18,000 over that 30 years. $600 a year times 30 years, $18,000. That's your level term life insurance policy. If you were to choose to have that same policy with a return of premium rider on it, then instead of paying $1,000, let's say instead of it being $50 a month, it might be $80 a month, right? Or $90 a month. So you're going to pay more for the benefit of having that refund available to you at the end of the term. ROP policies are good if you can't decide between term and permanent coverage. So if you're one of those people who has a problem with giving your money away and not really having anything to show for it, which you did really have the coverage, so it's not like you didn't receive any kind of benefit, but still, maybe you're that person that wants to have something that you can do something with at the end of the term instead of feeling like you've just paid all this money and have no options available to you to do something else at the end of the term. So at bare minimum, you might think, well, at least I can take that money and put it towards a new policy, right? That way I'm not just paying for term insurance and not having anything show for it. Now you might want to consider doing a different option, maybe a permanent policy with a lower premium might be a better solution for you. But again, a return of premium is going to be more expensive than the level term life. Again, level term life, annual renewable term, decrease in term life, and return of premium are the four types of term life insurance policy. For most of you on here, you're going to be going with the level term life insurance policy. All right, now, what factors determine your approval and rate? Now, these are going to be general factors. Okay, now, obviously, the specific factors are going to be based on like the product that for which you are applying, the company that you're applying to, things of that nature. But in general, the factors I'm going to show you now are going to be pretty standard across the board, no matter which company you choose. Okay, so these are the factors that determine your approval and rate. Okay, your health, that's your current and past health, weight, age, exam results if applicable, and your medical records, which again, if you are applying to a no medical exam policy, your exam results and medical records will not be pulled. Okay. Financial and credit. This is bankruptcies and collections, not so much late payments. They're going to look more at bankruptcies and collections. Your driving record, they're going to look for DUIs, DWIs, moving traffic violations, any accidents which resulted in injuries either to yourself or to someone else. Public records, liens and judgments there, criminal history, obviously, nicotine and marijuana use. Now, I personally don't like and agree with a cannabis user being classified as a smoker. What I have found is that life insurance companies will tend to look at the frequency of your use of cannabis and also the amount of cannabis that you're actually using to determine if you're ascribed a smoker rate versus a non-smoker rate. If you're doing a no medical exam policy, it's not going to be an issue unless you're being prescribed medical cannabis. But if you're a cannabis smoker, you're a recreational cannabis user, if you're doing a no medical exam policy, there's no way they're going to know you're using cannabis. But if the application asks you if you're using cannabis, you definitely want to make sure you're honest about that, because if you have a situation that comes up, you get in a car accident, something like that, somebody gets killed, you get killed, that could become an issue when it's time to pay out that death benefit if it's been determined that you were dishonest about something that was indicated on the application. That is something to keep in mind. Hobbies, which are your avocations and vocations, they're going to look at if you're in a high-risk profession and if you participate in any activities that are high-risk activities. For example, bungee jumping, all right, or for example, being a stunt person for a in the movie industry. So all of these are going to determine, again, number one, if you're going to be approved, and number two, if you are approved, what rate you're going to be approved at. Okay. Now, here's the thing with no medical exam underwriting. Now, no medical exam underwriting falls into three categories. Okay. So the main difference here is you're going to know which no medical exam underwriting you are applying for based on the number of questions they ask you. Accelerated underwriting is where they have immediate approval, but they ask extensive health questions. It might take you 20 to 30 minutes to answer the questions on the questionnaire. These policy types require you to have good health and good credit. By that, no bankruptcies, no collections, no charge-offs, no public records out there, no judgments. Okay, they're going to rely heavily on public records. They're going to look at the LexisNexis. That is what life insurance companies use to pull public records data. Your MVR and MIB report, obviously MVR report, that's going to be pulled from your driver's license, and MIB report is pulled from your social. MIB report is your prescription drug report. So here's another note I want to give you all. Don't think because it is a no medical exam policy that they don't have any information on you at all. They're able to pull a ton of information about you, on you, just from your social security number and just from your driver's license. Okay, so don't fall into the trap of thinking that you can have all this stuff in your background, have all this stuff going on, and get around those things being identified simply by applying for a no medical exam policy. Okay, so make sure if you're applying for an accelerated underwriting, you have really good credit, decent credit, and good health, and nothing on your public records report. If you are in that category where you're good credit, good health, nothing on your public records report, accelerated underwriting will be the go-to for you. You're going to tend to get higher approval amounts. In other words, your coverage will be more with accelerated underwriting, and you will tend to get better pricing on that coverage. Okay. The second and most commonly used no medical exam underwriting category is known as simplified issue. The vast majority of the no medical exam policies are going to be in this category. A simplified issue underwriting category is when you have immediate approval with a few health questions. They rely on some public records, primarily your MVR and your MIB report. They will not tend to go as deep into things as, say, a accelerated underwriting program, but they are going to still pull your driving record and your prescription drug report. So you do need to make sure that you are being upright, upfront, and honest about any drugs that you're taking, any moving traffic violations. Okay, they require average health and credit. Okay, credit is usually not a major determinant, but the main thing with simplified issue, you have a few questions and it's immediate approval. But with, as I said, with accelerated underwriting, the deal here is that you're not going to probably get as much coverage as you would get with an accelerated underwriting program. And the coverage you do get with simplified issue is going to be more expensive than, say, an accelerated underwriting deal or for a fully underwritten deal. Okay. And I'll talk to you a little bit about the difference between the pros and cons of no medical exam versus medical exam on the next slide. And then we have what's called guaranteed issue. Now, these are immediate approval, no health question policies. These are going to be for those of you who cannot obtain life insurance coverage anywhere else. Okay. You have a ton of health things going on. You cannot obtain coverage anywhere else. These policies have what's called a graded death benefit. That's just a fancy way of saying a waiting period. So they will, you will apply for the policy. They won't ask you any questions. You just need to you just need to be alive, and they will issue the policy. If it is a 2-year graded death benefit, that just means you're going to pay premiums for 2 years. Okay. If you die at any point during that 2-year period, you're not going to have the death benefit will not be paid out. The only thing that will be paid out are the premiums that you paid up to that point. So if you're paying, say, $50 a month for a guaranteed issue policy, and let's say you die at the end of 12 months, that means you would have paid $600 into that policy. If you die at that point, only $600 is going to be paid out, plus maybe they might give you a bonus of 5% or something like that. But if it's a $20,000 policy that's a guaranteed issue policy and you're paying $50 a month for that, you're only going to get back whatever premiums you paid in up to that point if it's within that waiting period. So that's how they're able to offer you the guaranteed issue, is because you have to survive that waiting period. Now, if you survive that waiting period, then obviously you'll have the full death benefit will be paid out if something were to happen. Also, guaranteed issue policies are the most expensive policies that you can buy. They have lower coverage per dollar of premium paid. Okay. These are going to be your final expense policies. These are your funeral policies. That's been the reason why they're usually called burial plans or final expense policies, is because that's usually all you can pay is final expenses and a funeral. Maybe, the most coverage you might get with a guaranteed issue plan might be 15 or 20,000, maybe 25,000 or 30,000, depending on the company. But even up to that point, you're still going to have a waiting period. So again, 3 categories: accelerated underwriting, simplified issue, and guaranteed issue. All right, so let's talk about the pros and cons of using a medical exam, a medically underwritten policy versus a non-medical policy. Most people do go for the no medical exam policy, but I'm going to kind of give you some things you want to think about when going for a medical versus non-medical or vice versa. So here is what you need to know in short. When a medical exam, if you are going to undergo a medical exam, okay, medical exam policies are going to be less expensive. They're going to provide you more coverage, but they're going to be slow to approve you. It can take, I've seen it take 45, 60, 90 days. It could take sometimes 4, 5 months, depending on how many medical records they have to order. That's the other piece. With fully underwritten policies, meaning policies that require a medical exam, they are going to request your medical records. So that is going to add time to the approval process. Even if the company will approve you in a week or 2 weeks, they don't have control over how long it takes your doctor to send over medical records. And if you're seeing more than one doctor, you're seeing a specialist for this, you're seeing your primary care physician on a consistent basis, that's a lot. Those are a lot of medical records. And obviously, no decision is going to be made on your policy until all of those medical records are reviewed. So again, the pro is that you're going to have, it's going to be less expensive. It's going to provide you with more coverage, but the con is that it can take a while. Okay. For the non-medical, the non-medical exam policies are going to be more expensive. They're going to provide less coverage, but they're going to provide quick approvals, usually within a couple of minutes of you answering the questions. Okay, you can be approved. If you are someone who is very price sensitive, okay, you want a certain amount of coverage, you want a certain amount of coverage within your budget, and you're relatively healthy, you don't have anything going on, you don't see a lot of doctors maybe, and if you do, you're pretty healthy, go for the medical exam, because you're going to end up getting a better policy. And when I say better, you're going to have more coverage, and the coverage that you do get is going to be less expensive. Okay. Non-medical exam policies are convenient in that they're quick, but you can't complain about not having the coverage you want, right? Or the fact that it's going to be more expensive because, again, it's a give and take, right? The more you give on the front end, the more you get on the back end. The less you give on the front end, the less you get on the back end. And that means less coverage, more price, non-medical, more coverage, less price, medical. All right. Now let's talk a little bit about the companies that you're going to choose, and that this is going to be rather quick here. So when you're deciding on what company to choose, this is going to be driven heavily by what is most important to you. And I have a few things on the screen here that you might want to take into consideration. First thing is company ratings and reviews. Life insurance companies are rated by uh, several ratings companies: S&P, Moody's, AM Best. AM Best is going to assign a rating of A all the way to F, A being the best, F being worst. You want to only work with reputable life insurance companies that are A rated. So that's something to keep in mind. It's not usually a big deal because you can usually Google life insurance company ratings and that information is all online. But if you're new to searching for life insurance, that is something you want to keep in mind. Also, are there living benefits? Right? Living benefits are additional benefits that you can pay for that allow you to use them while you are alive. That's why they're called living benefits. Examples of living benefits are to the right: chronic illness, critical illness, long-term care. You have heart attack, stroke, or cancer, for example. If you have a chronic illness rider, you can access a payment from your policy tax-free while you're living. That can be very helpful if you are, you know, diagnosed with a condition and you go to the hospital. There's a ton of medical bills that will have to be paid. Maybe your health insurance doesn't pay everything, which it usually doesn't. Well, this chronic illness and critical illness access agreement allows you to take advantage of benefits paid out from the policy without you having to die. Long-term care is another one, right? There are some term policies that give you long-term care protection if you are confined to a nursing home, you need home health care, different things of that sort. The living benefits uh, feature will allow that policy to pay out, or you'll be eligible for a payout based on the terms and conditions within your specific policy setup. Convertibility: some companies do allow you to convert your term insurance policy into a permanent policy. This can be very beneficial if you're someone who does not plan to have term insurance for the rest of your life. Maybe you're only doing it right now because you're married. You have, remember the ILL that we talked about. Maybe there's a greater need for income replacement, but maybe that's only for a short period of time. Or maybe you have more liabilities now, but you won't have those same liabilities in 20 years, for example. Then you might want to look at having a term policy that gives you a convertibility option. That way, instead of you going out and applying for a whole life policy or universal life policy, you can stay with the same company and just convert the current policy into a permanent policy. It's just a lot more convenient for you instead of you having to go out and go through the full underwriting process. And obviously by then you might be 20 or 30 years older. So you might have a more difficult time obtaining a permanent policy. So the convertibility option is a nice feature available with some companies, which allows you to convert your temporary coverage into permanent lifetime coverage and obviously have cash value, because permanent life insurance policies do build cash value. Okay. Also, do you have the option of changing your coverage? And when I say change coverage, I mean you some policies, some term policies allow you to reduce the amount of coverage that you have in future years. Again, this is about the flexibility that's available with some companies and not with other companies. Again, not every company is going to allow you to do that, but the reason you might want to do that is, as I said previously, you don't always need the same amount of life insurance coverage, right? You buy life insurance at 35 or 45, you might need a certain amount, but then when you get to 65, you're not going to need that much. Maybe you're an empty nester at that point. You've paid off your car, you've paid off your house, so you won't need that same amount of coverage. But obviously, you might need it for legacy purposes. So again, your needs for life insurance will change as your life changes. And so that's where, having that flexibility maybe to change your coverage might be something that's important to you. Okay. And then obviously there's some other benefits. The benefits that are available to you are not going to be the same with every company. There are some common benefits such as waiver of premium, which is a rider that or benefit that allows you to forego payment on your premium, your monthly or annual premium, if you become disabled. You can still maintain your life insurance coverage, while you're alive if you become disabled, according to the terms and conditions of the specific policy that you have. Some policies have inflation protection, which increases the death benefit every year along with the consumer price index, so that in future years your death benefit is not consumed by the higher cost of living, right? You're younger now. That $100,000 policy you buy now, if you die 30 years from now, 20 years from now, that $100,000 policy is going to be worth much less in future dollars than it is in today's dollars, because again, things get more expensive over time. So if inflation protection is important to you, then that's going to obviously help you, sort of narrow down the companies that you're looking at. And then guaranteed insurability is another good one, where some companies allow you to buy additional life insurance coverage without providing evidence of insurability. So you buy a policy right now from the company, they will give you a certain amount of time in which to purchase additional insurance. In other words, to increase your coverage, even though you may or may not be insurable. So in other words, they don't require you to justify the additional coverage. You don't have to go through underwriting again. So this is a great way, again, to have more coverage, okay, without basically just about having something that's convenient for you, where you don't have to go out and buy another separate policy with another company. If this company gives you a guaranteed insurability rider, you can just increase your coverage, right, with the current company and still obviously continue paying the premium, and then obviously, kind of make adjustments as you need in the future. Okay. So again, these are the bullet points you want to think about: company ratings, the living benefits, convertibility option, the ability to change your coverage as needed, and obviously some of the other benefits: inflation protection, waiver of premium, change of insured and guaranteed insurability rider. So this is really about helping you narrow your focus, because if you're searching for term life insurance, there's a zillion different things that you can look at, right? You don't know where you need to start looking until you first figure out what is most important to you. Maybe living benefits are not important to you, right? But maybe convertibility is important to you. Well, not every company is going to offer convertibility, so that's going to eliminate a lot of options for you. Or maybe convertibility is not important to you. Maybe the waiver premiums, none of this other stuff is important. The only thing that's important to you might be what? Living benefits. Do you have critical chronic illness and long-term care? If that is the driving, if that's the most important thing, guess what? You start with that, and then you can narrow down your options from there. So again, start with this. Okay, don't look at price first. Look at what the benefits are first, because I always say to people, you get what you pay for, but you also don't get what you don't pay for. So one of the biggest mistakes is only looking at price. You looking at price only and not looking at the other things, you might end up in a situation in 10, 15 years where you wished you would have paid that extra $15 or $20 to get that critical illness or chronic illness protection. I always say insurance is always expensive until you need it. It's always expensive until you need it. So again, don't only look at price, look at the other things here. If these are important to you, select one, narrow down from there, and then make your decision. All right, so now let's wrap up with some final tips on laddering, TIA, beneficiary designations, and your life insurance and your estate plan. We're going to tie life insurance in with your estate plan so you can be fully organized, set up for the future. Okay, so let's talk about first laddering. Now, this is all about helping you save cost and your total coverage. Now, we know how to arrive at our coverage, right? You have the rule of 10 or the rule of 20, right? Multiply your annual income by either 10 or 20, right? That's your coverage. However, that doesn't really give us direction on how the coverage should be structured. Okay, so let's use laddering. What is laddering? Okay, laddering is where you have multiple life insurance policies with different expiration dates to meet your coverage requirements and reduce your total insurance costs. So let's use a 35-year-old male, for example, to kind of drive that home. Let's say 35-year single 35-year-old male, you have no dependents. You make $100,000 a year. Okay? Well, that means you have $1 million policy, right? You have $1 million worth of coverage, stated another way. You have $1 million worth of coverage. That's going to run you about $76 a month. Now, having the $1 million number doesn't really give us direction on should it be a 30-year, should it be a 20-year, should it be a 10-year. That's where laddering comes in, because you can actually segment your coverage into different term policies and reduce the total coverage cost by doing so. The logic here is that as you get older, you will tend to require less life insurance coverage. Remember the ILL that I talked about at the very beginning of the presentation, which is what we're using to determine if you need life insurance coverage. Well, we know that if we're younger, we're 35 years old, we're going to need more coverage earlier, right? Because you got your mortgage, you have more, your kids are probably still young, right? You have a lot more liability, more of an income replacement need, more of a liability coverage need. So that's why your first 10 years, you might do a 10, 20, and 30-year term, and you might take that $1 million and you might break it up as 500,000 the first 10. The second 20 years, you do 300,000, and then you do a 30-year term for 200,000. So you'd have 3 term policies, a 500K 10-year term, a 300K 20-year term, and a 200K 30-year term. That is about $51 a month. So the difference between 76 and 51 is about 33%. So you've reduced your life insurance cost by 33% by simply segmenting your life insurance coverage between 3 different term policies, a 10, 20, and 30. And again, the 75.91 for the single 30-year term versus the 51.21 for a 10, 20, 30-year term, segmented out as a 500, 300, 200K tranche. That saves you a significant amount of money. So this is a strategy that you want to consider. Don't think about your life insurance in terms of one policy. Think about your life insurance in terms of a series of policies that are required to cover income replacement, liability coverage, and legacy preservation needs at different time intervals. Again, as you get older, the logic here, as you get older, your life insurance needs will decrease, so your coverage should be structured accordingly. All right? Now, temporary insurance agreement. A temporary insurance agreement is a temporary life insurance coverage contract that covers you from the time you submit a life insurance application until a underwriting determination is made. This applies to this applies to fully underwritten either permanent or term insurance policies. Okay, this could be important for some of you because you might be in a situation where you need life insurance right away. If you're going for a fully underwritten policy, okay, either term or whole life or universal life, but a fully underwritten policy might take a while, right? And we talked about that earlier. Full underwriting, they're going to ask you a lot of health questions. You're going to maybe do a medical exam. They're going to pull your medical records, maybe. All of that can take a while, 45, 60, 90 days. So the TIA is in place to provide you coverage during that time period. So if you want to go for a a fully underwritten permanent or term policy, and your concern is, oh, well, I'm not going to have insurance during this 90-day period or 60-day period or however long it takes, you can absolutely go with a life insurance company that offers a TIA. You will have coverage during the time of underwriting. Okay, that way you don't have to worry about not having coverage or not having sufficient coverage on your life during that waiting period. Okay, so that's something to keep in mind. Make sure you ask about TIA when it comes to, as it pertains to fully underwritten life insurance policies, okay, during the waiting period. Also, let's talk about beneficiary designations. Many of you are asking questions about who should my beneficiary be, Jerry? What does this mean? What is a contingent beneficiary? What are the rules that what do life insurance companies look at? So let me just kind of give you some things, some terms here. Let's first define a primary beneficiary. This is the individual or individuals who will receive your life insurance proceeds upon your passing. This could be either a natural or a non-natural person. Non-natural means a business entity, a trust, for example, can also be your beneficiary. You want to leave your life insurance proceeds to your alma mater, to your church, to a favorite charity. The list goes on. You can absolutely do that if you do not have a natural living beneficiary that you want to choose. You can absolutely name a non-natural beneficiary. Also, there is something called insurable interest. Life insurance companies look for insurable interest as it relates to who the beneficiary is and or who the owner on that contract is. And that comes into play where you might be owner on a policy for someone else, for example, or vice versa. Someone might be owner on a policy where you are beneficiary, etc. All of these different things can kind of be structured based on the individual situation. However, insurable interest just states who would suffer an economic loss, who would be the person that needs income replacement, who would be the person that would need liability coverage, who would be that individual that you would want to have a legacy perpetuating element for. Okay, insurable interest focuses on economic loss primarily. So just make sure when you're naming beneficiaries that they are individuals who have an economic interest in your income, in your assets, or you may not have a person that has insurable interest, but be prepared to answer some additional questions if that is the case. Okay. A contingent beneficiary is an alternate beneficiary who will receive your life insurance proceeds if the primary beneficiary dies before you or is unwilling or unable to receive the life insurance proceeds. A good example is you have an older parent who is a single parent, your older parent passes away before you pass away. Who would be your beneficiary in that case? The contingent beneficiary will be the person next in line. Okay, so if the primary beneficiary is unavailable, they're deceased, can't be located, whatever, the contingent beneficiary will be the person next in line. Not to be mistaken for a co-beneficiary. A co-primary is a person who has an equal share. Maybe you have 50% to this kid, 50% to this kid. Those are two primary beneficiaries. You have a contingent beneficiary, which again is if the primary cannot be located or is unwilling or unable to receive proceeds, then you would have that person. So you may be asking, well, why would someone be unwilling to receive life insurance proceeds? Well, good example is stress tested or means tested benefits. For example, Medicaid. Medicaid looks at income and assets. So if someone is going to be disqualified, has a high likelihood, a good likelihood of being disqualified from certain state eligible programs, right? Based on their income and assets, they may not want to receive those life insurance proceeds, right? So in that case, that's where having an estate plan comes into play, where your contingent beneficiary might be, for example, a trust, just as your primary beneficiary could be, for example, a trust. That way, they can still have, for example, benefit to those assets, but not have those assets be counted against them for, say, eligibility purposes for programs like Medicaid. Okay. Also, if you do not specify primary beneficiary, your general estate will be named as beneficiary by default, and all the probate rules would apply per your state law. Okay, so make sure you do have both a primary and a contingent beneficiary so that the life insurance proceeds do not end up in probate, which probate can take anywhere from a year to a year and a half to get resolved. It is not free. Okay, so there's fees, there could be taxes. And so rather than going through all of that, have a primary, have a contingent, and avoid that altogether. And make sure you do have an estate plan paired with your life insurance policy. Okay. Also, I advise against naming children as minor children as primary beneficiaries, because any assets left to minor children, by minor children, I mean any children who are under the age of 18 or 21, depending on the state. I believe there's some states where it's 17. But any child that is under the majority age for that state who is left assets, those assets would be subject to UTMA rules. That is a federal law that governs the taxation of those assets and the treatment of those assets. So what that really ends up meaning, and from a practical application standpoint, is that someone else will have to manage those funds for the kid until they are old enough to manage those funds on their own. Okay, now if you're married, you pass away, obviously it'll end up being your spouse. Okay, that's pretty straightforward, but it can get really complicated if you are a single person. Or maybe, let's say you, even if you're married, let's say you're married, you pass away, the husband or the wife becomes the custodian of those assets. Well, what if the husband or wife that that is the custodian, what if they pass away? What if they pass away while the kid is still a minor kid, right? Now you have a problem. So what we want to make sure we do is have number one, what's called nominations of guardianship, which is one of the 5 core documents of your estate plan. Make sure you have a nomination of guardianship. Okay, that should be a part of your estate plan. And make sure you also have a trust as well. Okay, that way you can avoid a lot of the issues that come up during the probate, as well as having custodial arrangements or agreements that may not be in line with your final wishes. Okay, because if you don't specify, the state will specify, and that's usually not going to be what you want. Okay, so make sure you're cognizant. Don't make children beneficiaries on your life insurance policy if they're minor children. Okay, and also this, again, sort of being redundant, your life insurance and your estate plan should be consistent. Okay, and final word, which kind of a continuation of that point, this first bullet point, your will may not override life insurance policy designation. So again, as I said on the last slide, make sure that your will and your life insurance, your estate plan and your life insurance policy are consistent For example, if you don't have an estate plan, you have a will. Your will says one thing as oh, I want so and so to be recipient of these assets, but your life insurance policy has someone else. Well, if there's a conflict and something goes into probate, they're going to usually go off of what the life insurance they're going to defer to the life insurance contract in most cases. Okay, so just make sure you are be mindful of state law, which goes into the next bullet point, and keep your estate plan and your life insurance policies up to date. A lot of the issues that come up with contingent beneficiaries not being named or being named, but not being up things not being updated, just not updating and not looking at the stuff, not being organized, creates a ton of issues that can be avoided. Okay, so make sure again you're mindful of state law. Whatever the state law dictates in your particular state will override any thing that you put in the life insurance contract and or your estate plan. And make sure you're organized with your life insurance policies and estate plan documents. If they don't know where anything is and you pass away, what good have you done? If they don't even know that they're supposed to be receiving anything, they might be in a whole different state. They may have changed their address and their phone number, right? How are they going to know that they have life insurance that's coming to them? Have you told anybody where those documents are? So again, make sure you keep both a digital and a physical copy of all of your planning documents, okay? All right, that concludes today's presentation. I'd like to thank you all for sticking around and listening today. I'm pretty sure that you all found the information helpful. I'm going to invite you all to work with me. If you're interested in working with me, my company is the Black Wealth Company. We work with Black families in all 50 states. Okay, we have clients in 30 states, but we're able to work with clients in 50 states. Okay, if you want to obtain a quote for a term life insurance policy, you can actually click the link either below this video if you're watching on YouTube, or if you're watching in the webinar platform, you can click right below and it will take you to the quote screen. All the policies are streamlined approval. So that means there's going to be few health questions. The reason why there are few health questions is to determine which policy type you qualify for. Remember what I taught you all before. Everyone's health is different. Everyone's credit situation is different. Everyone's age is different. The good thing is there's immediate approval for 95% of you. So 9.5 times out of 10, you will be approved. Okay, that's the goal here, is to get you through the process, get you approved. Simplified issue policies, few health questions. If you do not qualify for the simplified issue based on your health, the system will automatically offer you a guaranteed issue policy. Okay. Also, all estate planning documents are included with most plans. Okay. So that is great because we talked a lot about estate planning towards the end here. And it's going to be very difficult to really have a well thought out discussion about life insurance without really incorporating that discussion of estate planning. Okay, so again, estate planning documents are available with most plans. That's going to include your power of attorney, your healthcare proxy, your will, and your trust. And the term plans, all of the term plans have what's called an annual renewability option. Remember, that's one of the 4 types of term policies. So you're going to be able to maintain that term insurance policy even if you outlive that term. You don't have to worry about reapplying for life insurance or maybe being declined because your health has changed by the end of the term. All you have to do is just continue to pay that annual premium. It's annual renewable, so it will increase each year as you get older. But the good thing to that is, a trade-off to that is, if you don't have to worry about not having life insurance. Okay, so again, click the link below, a button below to request a quote, and then it will ask you a couple questions, and you can actually finalize your policy completely within 5 minutes. Again, 95% approval, media approval for 95% of you, no physical medical exam. If you need another type of policy, for example, a universal life policy, you're looking for a whole life policy, we can absolutely help you with that as well. On the next screen, you're going to see our telephone number, my office telephone number is there. You can absolutely text or call that number if there's another plan that you are seeking that may not basically be offered to you on the portal. We can absolutely work with you and with those as well to secure a plan that is going to be in line with what you're looking for. But again, click the link below to request a term quote. After that quote, you can go ahead and submit and be approved and have your policy started right away. Thank you all so very much for watching this presentation. Stay blessed. I'll see you on the next video. Bye for now.